Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, November 14, 2018. You're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So we had another down day out here today, and it's not really that unexpected. I keep saying we're looking for a low, doesn't mean it's coming the next day or it just happened the previous day. We're looking for a low. Important prices matter, so we're looking for a low specifically at important prices, and we hit an important price tonight. We're going to talk more about that as the video goes on, but I think I have a pretty good schematic of what to expect over the next couple of days. So we'll get into that in a couple of minutes. First, let me back up and thank everybody for continuing to make comments and posts underneath the video each and every night. It's very helpful. I love the participation and the interaction of the entire community. Please keep up the good work. In addition, please hit the like button on the video and share the video with anybody that you think can benefit from this information. All right, back to the spiders. Now, we had a down day and we came into an important price level. How do we know it's an important price level? Because it's been on the chart for a while. 269 and then 267.77. These are areas that I figured would get hit. So one got hit today, and the question is it enough? Are they going to fill the gap, or are they going to leave it short? And the reality is, I think they're going to fill the gap. Let me explain a little bit more about why I feel that way. Now you're going to take a trek inside my head. You know that's a dangerous place to be, but nevertheless, let's go there now. Why isn't just hitting 269 today good enough? And by the way, I need to show you something kind of cool. Here's a 10-minute chart, and look what happened the first time price hit 269. The low in that candle was 269, and then we bounced right off of it, right to, I believe it was 269.62. That's good for 6 ES points or 6 S&P points. Then, of course, we came back and did the retrace, and then the market rallied but faded at the end of the day, which brings me to my next point. This isn't how lows are made. We're looking for a low, but it's not how they're made. We had another higher opening today, and then the market faded. We've seen that repeat over and over again. What we really want to see, and it's similar to what we discussed a couple of weeks ago on the previous bottom, we want to see one of those real flush out gap downs, scare the heck out of everybody, and then reverse at some point intraday, finish near the highs. That's a reversal. We can take off from there. That's what we're looking for. Where's that going to take place from? When's that going to take place? We can't know for certain that it will take place. But here's my theory on this. And this isn't technical. This is inside my mind. This is theory. They didn't do it the last time. They didn't put in the ideal low. Now, the market's not going to always do the ideal thing. We all know that. It doesn't give you what you want on a silver platter. That's not the way the market works. However, never really put in what I would call a legitimate bottom before. Why not this time? Does that bottom have to make new lows? It's possible. It can make new lows. That would be a washout scenario. That would be a Black Monday type of scenario. We would be down 150 S&P handles on a Monday. That's the type of thing that would make new lows, and we can reverse from there. It wouldn't necessarily happen the same day, but that's what would happen if we were to make new lows. It would be very, very ugly. The reason I say it would be very ugly is because I don't think that we would creep down to make new lows. I think if the market was going to make a run for the previous lows and make new lows, I think it would happen in rapid fashion. So let's discuss what the common thing would be, what my expectations are. I'll give you on the downside what the outlandish would look like, and then we'll go over what my expectations are going forward. If we're going to fill the gap, and let's just say we do get a gap down, maybe it's tomorrow morning on Thursday, maybe it's Friday morning, but if we get a gap down and they fill the gap, they're probably not going to just stop at the gap. They had an opportunity to fill the gap today. They chose to bounce off the 269 price that we discussed previously. And so if the market actually came back down for the gap to fill the gap, I wouldn't expect them to stop at the gap. I think they had that opportunity today, so I would no longer be interested to buy the gap. Today I was interested to buy 269 for a trade. I was interested to buy 267 for a trade. Tomorrow, I'm not interested to buy either for a trade. Am I interested to buy stocks? Yes, that's a different story altogether. We're just talking about the index. We're talking about the S&P, specifically the SPY, where I would be willing to or am willing to make a long play on the spider. Was at 269. That play is over. It's done. It was a trade. It was an intraday trade. Why didn't I buy a longer term position knowing that the market would likely find support at 269? Well, because we haven't seen a sign or signal of a trend change yet. I want to see that on a daily chart before stepping into a larger/longer term swing position. So if they're not going to stop at the gap, where's the next likely area they would stop? Well, based on my work, it tells me somewhere between 266 and 267, so we'll call it 266 and a half. So there, now we have a changing of the guard. I moved some targets around. We've already satisfied the 269. Maybe the market does take off from here. That's fine. I don't know that it will go lower. I'm giving you the scenario that if it does go lower, and we know that we would really love to see a gap down in the morning and a reversal in order to put in a bottom, that's the ideal scenario. So I'm giving you what happens if. Now the next thing is, what happens if 266, 267 area doesn't hold? Well, they can certainly go a little bit lower, but we're discussing the general zone. So what we do is, if price gets to that area, we begin looking for and utilizing all the other things that are taught in the Lazy E-mini Trader course. We use those to our advantage to look for signs of a bottom. How long was the market trending in a certain direction? Is there support in a general area? Now, is there more support from different time frames? We put all those things together to determine where the trade is and when the trade is, and that's how we do it time and time again. It's very hard to tell you making a video a day or two before it could even possibly happen, getting down to 266, for example, and what the market will look like at the time. What does it look like in terms of, is it a global sell-off? Is the market selling off on heavy volume, on light volume? Is it a gap down? Was it a gap up with a fade? There's too many factors, too many variables to say, yeah, I'll definitely buy 266 if it gets there. Is it likely? Yeah, it's very likely. But I'm just reminding everybody that those type of decisions have to be made in real time based on the data and information that's available on the charts, everything that we learn in the course. That's the way it works. Now, what's my expectation? My expectation hasn't changed. We're looking for a low. We may have found it today. We may find it tomorrow. Maybe we'll find it Monday. But we're looking for a low somewhere in the general zone. 269, 266, maybe somewhere in between. If we begin closing daily below 265, for example, and we begin trading lower, then you can expect that they'll make a run for the low of this breakup candle. They'll fight that. Closing below that is trouble, and you don't want to be long the market if that happens in my book. Now, expectations. So my expectation is that the market's going to find a low. We've made an A leg. We're making a B leg. It's going to end somewhere, and we're going to have a likely C leg to follow. The C leg completes officially above the high of the A leg. Now, it's obviously premature. We haven't even bottomed. There's no proof this is a B leg. We won't know it's a B leg until the market turns into the C phase. I'm putting all the pieces to the puzzle together. I'm looking for a low for my own reasons. The market has already put in 2/3 of the required pattern. The only question is, does the second third hold? And that's what we have to wait and find out. Now, just to touch on, just to make sure everybody's aware, if in fact we close below the low of this breakup candle, okay, 263.12, just call it 263. If we close below 263, there's a likelihood of new lows. By how much, it's hard to say. We'll likely get into the 2500s in the S&P 500. That's 200 points lower than we are now to 2500. So maybe 150, 125 points below where we are now. I'm not saying that's going to happen. It can happen. It's always a possibility We have to understand what the possibilities are if it begins to happen. Look, these things aren't something you can trade for. If you happen to be in a position that benefits when those type of events happen, then you tip your hat and you move along. But we're not swamis here. We're not predicting the next crash. That's not the way it works. You always hear about the one trader that had this enormous position that paid millions of dollars on the huge down move. But what you don't hear about are the millions of people that lost their ass. So what we don't do is we don't anticipate those things happening. If we happen to be in a position when they do happen, that's fantastic. My expectation is we're looking for a low and we're going to have another rally leg, at least to complete the ABC pattern. That's my expectation today. The IWM. This is my favorite market leading indicator. Everybody under the sun knows that. There's been a lot of discussion about the quote-unquote crossing or death cross, as they say, of the 50-period moving average crossing over on the daily chart of the 200-period moving average. Is that good news? Of course it's not good news. It's negative news. That's why they're discussing it. Can it be detrimental to the IWM? Absolutely. Is it likely to play out by next Thursday? Not so much. Again, if we have a flush lower in the market and they open the trap door and we make new lows, the IWM is obviously going to make new lows along with everything else. However, just to address what a lot of traders or analysts or pundits or whoever discussing, the crossover, the death cross. I get it. It's important. We're watching it. We certainly will make it a puzzle piece on the table. We discussed it briefly last night. But what this doesn't mean, and this is what I want to stress, it doesn't mean the market has to go immediately down. We can have a rally and still have this impact the markets later on. That's why a lot of traders, investors, just people in general have a difficult time separating short-term things from long-term things. They can both be right. We can make money paying attention to both short-term and long-term, and they can both contradict each other at times, and we can still be right on all counts. That's what we need to understand and pay attention to. We need to focus on what's our current outlook on whatever chart or market we're looking at. How does the weekly chart look on IWM? Doesn't look so hot. You can see what's going on here. It looks like it's putting in, we'll call it a bear flag pattern. It probably needs some more time to develop, which means we can have rallies in between. That's my point. When you look at this weekly chart, and let's just say for argument's sake, the market doesn't go immediately down. Let's just say we do have a rally, even for a couple of weeks. Can the IWM rally up $4 or $5 and not disturb or disrupt this pattern in one way, shape, or form, or any way, shape, or form whatsoever? Absolutely. So that's my point is we can have a rally and still stay in this bear flag pattern. It can also break down. Time will tell. It's going to happen sooner than later. We're going to know within the next session or two, day or two, whether we're going to get this rally right away or we're going to have to strap on our seatbelt for lower prices and then rally from lower prices. Either way, it's coming. The transports. We can't really get any information from the transports from today. We had a pretty wide-ranging day in the transports, and we finished pretty much near where we opened. The margin of error was too slim, 0.2%, so we're going to call that a flat day for all intents and purposes. And the transports, I can make a case this is a bullish pattern, but we can fail if it gets below the 20-period moving average and starts closing hourly below that price level. Then there's trouble, but I can certainly make a case that this looks like one of the more healthy charts relative to the rest. Remember, this was one of our possible canaries in the coal mine long before the market. We saw the transports rallying before the market rallied when bottoms were being made. This is a good canary in the coal mine. This is why I like the transports. It's my second favorite market leading indicator. Look where we are in the transports and compare it to where we are in the spiders, for example. So we'll flip over to the spider chart. So in the transports, what I want to notice is, or what I want you to take note is how far away we are from the bottom. So there's the bottom, and here's where we are now. Okay, this is basically where price closed today. All right, down here. So we're pretty far. It's like 700 points, right? So if you think about it, if we're going to make new lows in the transports and come down more than 700 points, 800, 900 points in the transports from where we are now and make new lows, that's a crash scenario in the market. So these aren't things you plan for. These are things you're aware of. Unlikely scenario. Technology, here's the Qs. They're weaker. The Qs and the IWM are the weakest. Technology, small caps, and we've talked about this many, many times. That's where money goes for risk, for excess risk. They rise the fastest, but they fall the fastest. That's just the way it works. Nothing new here to report. Everything we discussed as it relates to the spider chart and the expectations applies across the markets. All the markets are trading together in sync right now. You're going to get different percentages of up and down day to day, but they're all trading together. Qs fill the gap. But if the market's not going down, there's lower to go. We'll just let it fall. Remember, we're looking for a low. I know it doesn't feel that way, and I know there's many people out there that think I'm absolutely bananas, wear a tinfoil hat on my head, the whole 9 yards. That's okay. I'm used to it. Here's the XLF. Now here's what I'll say about the XLF. Looks similar, not the same, but similar to the transports. Now, what I'll say about the XLF is, if this market was getting ready to collapse, why wouldn't the financials be signaling it ahead of time? They don't have to. It's not a requirement. I've just been doing this a long time. I've read these books. I've been to these movies. They don't all look the same, but many of them are similar. And I would say under normal conditions, if the market really has some significant short-term underlying problems, the financials would be lower than they are. The XLF would look like a different chart than it does. I think it would look more like the financials and the IWM than looks like the XLF does today. They have a gap to fill underneath, so be it. I just don't see us making new lows right now. Here's a term which is a blast from the past, and I never really liked this term. Here's a green shoot. How about the SMH up 50 cents today while the market was down? Is that some kind of a little tiny baby canary in the coal mine? Possibly. Keep an eye on it. It's a puzzle piece. It's on the table. Chart looks terrible. They all look the same, but we're looking for a low when nobody expects one. Let's switch lanes for a second, talk about Apple. So yesterday we talked about a range, 190 to 183. I think 183 is most likely a pretty good buying opportunity for Apple if we can get there. We're getting close. If we get some kind of a flush in the market and we go below 183, you can see there's a number of other areas that are important. There's a gap window, there's another gap, there's another gap. So it's hard to say. Those are the decisions that have to be made in real time. As it stands now, if the market has intentions of making a low in the next day or two, and we're not making new lows, then 183 is going to be the spot in Apple. Traders that have taken my course will know exactly where it's wrong. The risk is more than reasonable. It will be wrong small and fast if it has to be wrong. I just want to do something from a psychological perspective. So we know Apple is down. It's been down hard. It even got downgraded today. Now, it was downgraded by a firm called Guggenheim. Now, my guess is if you asked 100 people on the street if they've ever heard of Guggenheim Investments, probably 98 of them never heard of it. So here's what I'm saying. Why are they downgrading Apple at the lows? Where were they at $225 a share? Where were they at 200? Where were they when basically everybody at the time that owned Apple was up on Apple? Now, when everybody's popping pain pills, they're downgrading the stock after it's down almost $50 from the high. Thanks, Guggenheim. This is what I talk about over and over, folks. This is why you can't listen to these morons. Let me guess. The media would have you believe that Apple was down today on the downgrade by Guggenheim. Really? So it's not just heading for the 183 and a quarter that we talked about last night? Not knowing anything about the Guggenheim downgrade? They all do it, whether it's Goldman Sachs, UBS, Morgan Stanley, Raymond James, Guggenheim, whoever it is. They upgrade stocks at highs and they downgrade them at lows. If you're a conspiracy theorist, then they're doing it on purpose for their own benefit. I just think they're stupid. Not because they're stupid individuals that work there. There's very smart people that work at all these places. The reason why I use the term stupid is because they never learn from their mistakes. They do the same thing over and over and over again, year after year, decade after decade. They do the same thing over and over. Go back and look at all the firms that upgraded Apple when it was over here back in like October, and now they'll start downgrading it. Fantastic. How about Alibaba? Why am I talking about Alibaba? You've seen me bring up the chart of Alibaba a lot of times. Why am I discussing it today? It was up $3.50, 2.39%. Why is that important? It's called relative strength. What that's telling you is if, and it's a big if the market stages a rally, and if I'm right and we find a low, what do you think's going to happen to stocks that show relative strength? Relative strength means that they're not being dragged down with the rest of the market. How in the heck is a stock as widely held as Alibaba up $3.50 today when the NASDAQ composite was down almost 1%? Doesn't make sense. Relative strength. You have to pay attention to that stuff. We're going to mix it up a little bit, and now we're going to go over 2 lanes to the left. Talk about natural gas. Of course we have to talk about natural gas. It's the talk of the town. Doesn't even matter what town you live in. Where's the top in natural gas? We're close. Markets don't do this and get away with it. I'll give you the opposite of what we've been talking about in the spiders. We're looking for a top. I already dipped my toe in a little bit to the short side of natural gas, but I'm willing to add there's not that much more to the upside. And here's the reason why I did that. Well, for example, we're looking for a gap down in the S&P. We're looking for a gap up in natural gas. I'm looking for this to gap higher and then have a crap out. So we're looking for a gap and crap in natural gas. So sometimes they'll actually do all the deed overnight. They'll actually do it and they won't let you in the middle of the day. Like, for example, with natural gas, I'll play this. I am playing this with put options. So I know my risk. I bought a few contracts. I'm willing to add more. It's not a big position. I just can't let them get away with this. I know it's going to come back down to earth. So I did it with UNG. Where's the top in natural gas? Well, the NG can probably get to about 520. After about 520, I just don't think it has any more mustard in the jar. Right now, we're at 469. The high today, I'll move this over so everybody can see it. The high today was 4929, so we'll probably break into the fives and then they'll reverse the market. That's my take on the natural gas market. Gold, we touched on gold last night. I really didn't have much to say because it was that obvious, and then today it's that obvious, so there's really not a lot to say in gold. I really don't have to say anything. If you took the course, then you know exactly what I'm looking at. You know what I'm talking about. It was a long trade yesterday. It just is what it is. If you play by the rules, you had a very tight stop-loss limitation, and it was one of the easier trades on the board. Crude oil, fluttering around here. I think crude's going to get down to 53. So far, it's finding some stability around the 55, 56 area. Tried to rally a little bit today, but didn't get very far. So I think it's going to go down to 53. If you get a trap door and we have another down day or two in the market to a big degree, then you could get that flush lower in crude to the 53. 53, based on what's happening in real time, I would get interested in being long crude oil. And folks, that's my story tonight. I'm out of wind. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.